Welcome to the Max Dividends channel, where we help people build growing passive income, retire early, and live off dividends. In every Academy case, we take one stock and run it through the same checklist so you can see, step by step, whether it really deserves a spot in a serious dividend portfolio. Today we're examining PPG Industries, ticker PPG, a global leader in paints, coatings, and specialty materials embedded across construction, automotive, aerospace, and industrial production worldwide. We'll answer, how does this company make money? Is it a good stock to hold long-term? We'll walk through the Max Dividends checklist, test its financial condition with the 5-pillar secret formula, see what role it plays in a dividend portfolio, and finally ask if PPG is attractively priced today. How this company makes money. First question, do I clearly understand how PPG Industries earns its money? And does that business model make sense for dividend investing? PPG generates revenue by developing, manufacturing, and selling paints, coatings, and specialty materials used across construction, transportation, industrial production, and aftermarket maintenance around the world. Cash flow is driven by recurring maintenance cycles, repair activity, and the constant requirement to protect and extend the life of physical assets, not by consumer fads or short product cycles. The core earnings drivers are performance coatings, serving automotive refinish, aerospace, protective and marine coatings, and infrastructure needs, with demand supported by ongoing maintenance cycles and the constant requirement to protect physical assets across end markets. Industrial coatings, supplying coatings built into production processes for automotive, packaging, appliances, and other industrial customers, creating close links to global manufacturing activity and long-term customer relationships. Architectural coatings, serving professional painters, contractors, and retail customers with paints for residential and commercial use, supported by renovation demand, repaint cycles, and new construction activity. Technology, formulation, and customer integration, technical know-how, product performance, and the ability to meet exact customer specifications in reliability, durability, color consistency, and regulatory compliance strengthen customer retention and support pricing power over time. In other words, PPG Industries is not a black box. It's a scaled, globally integrated coatings business tied to production, repair, refurbishment, and long-duration asset upkeep. Exactly the kind of structure that can support a long dividend record when paired with conservative financial management. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter is simple, at least 15 years of consistent dividend growth. PPG Industries doesn't just clear that bar, it shows the classic stair-step dividend pattern long-term investors want, with 55-plus consecutive years of dividend increases that qualify it as a Dividend King. Annual dividend per share rose from roughly $1.10 in the early 2000s to about $2.77 most recently, with no visible reset or panic cut. That progression points to a payout backed by recurring cash generation and a management mindset that treats the dividend as an ongoing obligation, not a discretionary reward reserved for the easiest parts of the cycle. Step 1 passed, PPG Industries behaves like a genuine dividend eagle, with a resilient record of dividend growth that holds up across industrial, construction, and manufacturing cycles. Step 2. 5-pillar secret formula. First pillar, sales growth, the foundation. On a 10-year view, PPG Industries' revenue moved from roughly the mid-$14 billion range in the mid-2010s to about $16 billion most recently. The path is not perfectly linear, and that is exactly what investors should expect for a company influenced by industrial production trends, construction activity, automotive builds, and raw material pricing. The resilience across the cycle is the stress test. When conditions soften, volumes can dip. The key is that PPG continues operating from a solid long-term revenue base, showing the embedded role of its products in recurring maintenance and repaint demand. Sales growth past. PPG Industries' resilient long-term revenue base supports the view of PPG as a durable industrial platform with a credible foundation for dividend growth. Second pillar, profit growth, the fuel. PPG's profit trend stays roughly in the $5.5 billion to $6.6 billion range over the last decade, with softer periods followed by recoveries. That pattern matters. It suggests PPG is not dependent on one unusually strong year to support its earnings power, but instead operates from a profit base that holds up across changing industrial conditions and input cost swings. The driver is technical know-how, customer integration, and disciplined execution, supported by demand tied to repainting, repair, and asset protection that is linked to preservation and ongoing operations rather than purely discretionary spending. Profit growth past. PPG Industries' durable profit base strengthens dividend reliability and supports the case for continued dividend growth. Third pillar, net income, true strength. Net income begins in roughly the $0.8 billion range, rises above $1.5 billion in stronger years, and the decade's pattern includes softer periods, rebounds, and a finish pointing back toward the upper end of the range rather than toward deterioration. That is exactly what we want to see. A business that stays solidly profitable through industrial cycles without suffering a lasting earnings breakdown. Net income past, a resilient earnings profile across the decade, reinforces that PPG's dividend growth is supported by real operating durability, not a temporary upswing. Fourth pillar, dividend payout safety, protecting passive income. For most of the period, PPG's payout ratio stays in a reasonable band, generally moving between the high 20% area and the mid 50% range. There are fluctuations, but nothing that suggests the dividend has become detached from the company's earning power. The ratio rises when the earnings base softens and falls back when profitability improves. Exactly the behavior you want from a company exposed to manufacturing and construction cycles. The dividend policy stays measured even when the operating backdrop becomes less favorable. Dividend payout safety past. PPG's payout ratio has remained within a sustainable range, supporting the view that the dividend is well covered under normal conditions and positioned to keep growing without unnecessary strain. Fifth pillar, debt burden, avoiding traps. PPG uses debt, and for most of the decade the ratio stays around the mid 0.6 to 0.7 range, a workable zone for a mature industrial company. The one clear exception is a recent jump to roughly 1.4, which stands out sharply against the earlier pattern and is the main point dividend investors should watch closely going forward. Debt burden. The recent spike is the clearest balance sheet risk in the case and deserves ongoing monitoring, even as the rest of the financial profile remains strong. PPG Industries' overall financial score comes in at 98, very safe in our framework, signaling a business with strong fundamentals and the kind of long-term resilience dividend investors want to see. Does it fit our plan? This is where we move from, is it a good company, to what job should it have in my portfolio? MaxRatio combines three signals: current dividend yield, dividend growth, and financial strength to classify stocks as growth eagles, balanced eagles, or income eagles. PPG Industries' MaxRatio is 4.94, which places it firmly in the balanced eagle bucket. With a dividend yield of 2.75%, PPG offers a solid stream of cash today without chasing high-yield territory. The appeal is in its overall profile, approximately 32% cumulative dividend growth over 5 years, a payout ratio that has stayed within a sustainable band, and 55+ consecutive years of dividend increases that reflect long-term capital allocation discipline across many different industrial environments. In practice, PPG Industries is a balanced core holding, a respectable starting yield paired with a long runway for annual raises, built on recurring coatings demand and maintenance cycles that repeat year after year. It fits investors who want steady dividend compounding from a high-quality industrial franchise and can accept cyclical earnings variability along the way, while keeping an eye on the debt trend. Is the stock undervalued today? Here the signals are broadly supportive. Versus peers, PPG screens as undervalued in the Max Dividends app, meaning the market currently assigns it a cheaper than average valuation relative to comparable industrial and coatings names, suggesting more earnings power per dollar invested than much of the sector. Versus its own history, The current PE is around 15.45 versus a 10-year average near 24.15, meaning investors are paying materially less than usual for each dollar of PPG earnings, a clear discount to its own long-term valuation range. On yield, PPG pays about 2.75% today versus a long-term average near 1.79%, meaning the starting income is well above what investors have typically received, a more generous entry point than the stock's historical norm. Analyst consensus sees meaningful upside, with an average 12-month price target implying roughly plus 15.68% upside and an overall lean toward buy, reflecting confidence in business conditions improving and valuation normalizing toward historical levels. Final decision. Taken together, PPG Industries looks like a high-quality Dividend King, where valuation, yield, and peer comparison are all pointing in a favorable direction. Undervalued versus peers, trading below its own long-run average multiple and offering a yield well above its historical norm. That is a more supportive setup than usual for a 55-year dividend grower. For dividend investors, PPG makes the most sense as a balanced Eagle core holding with a long horizon. A solid 2.75% starting yield paired with a proven dividend culture and the potential for that payout to keep rising steadily as PPG executes across its coatings end markets. The one risk to monitor closely is the recent jump in debt. That balance sheet shift is the main watch item and deserves attention alongside margin resilience and broader industrial demand trends. Subscribe for more analysis. This is not investment advice.